Are we on the brink of another housing market crash?
That's correct. Experts like George Gammon, Emily Brown, and Xueqin Jiang break down the crucial indicators that could signal a downturn.
In this compilation, we've condensed their extensive analyses into time-saving, AI-powered summaries that deliver critical insights directly to you.
Buckle up, we'll dive deep into the current state of the housing market with George Gammon first, who highlights alarming trends.
And stay tuned. Emily Brown and Xueqin Jiang have more insights that could impact your financial decisions.
Just a reminder, this content is for educational purposes and not investment advice.
Today, we're examining an analysis by George Gammon on what trends typically precede housing price drops.
Gammon reviews essential economic indicators that can signal declines in the housing market.
George Gammon indicates that alterations in investor sentiment can serve as early warnings for housing price corrections.
He mentions that economic signals like rising interest rates and increasing inventory often precede price drops. Gammon observes that negative shifts in investor sentiment often lead to decreased buying activity.
This cautious attitude from buyers can create downward pressure on prices. George Gammon highlights the effect of rising interest rates on mortgage affordability for prospective buyers.
Moreover, an uptick in housing inventory may indicate forthcoming price declines.
Gammon warns that a notable rise in new housing listings can often correlate with price corrections.
As buyer competition dwindles, more homes may enter the market, again placing downward pressure on pricing.
According to George Gammon, if current trends persist, we might anticipate considerable housing price drops.
He also notes that the market's stability hinges on overall economic circumstances.
In closing, George Gammon recommends that homebuyers thoroughly evaluate market conditions prior to making purchasing decisions.
For investors, considering diversification of portfolios may prove advantageous in mitigating potential risks.
Today, we're analyzing the housing market crisis with insights from Emily Brown, who offers a comparison to the 2008 downturn.
Emily highlights that builders are currently operating under pressure due to rising costs and fluctuating demand.
Emily Brown indicates that today's challenges closely resemble those before the 2008 crisis.
She notes that financial pressures and potential mismanagement could risk a downturn. According to Emily, the combination of rising construction costs and increasing interest rates is creating a challenging environment for builders.
This not only affects new builds, but also the total housing supply. Emily observes that builder sentiment has dropped significantly.
This decline in confidence signals the current market conditions. Emily cautions that potential homebuyers may struggle as inventory continues to decline.
Investors are also adjusting their strategies due to fears of a market downturn. What does Emily foresee for the housing market going forward?
Emily predicts housing prices could decline further if current trends persist. Emily suggests many builders will slow down construction to mitigate risks.
This could lead to changes in how the industry operates. Emily concludes that builders must adapt rapidly to survive in this challenging market.
Homebuyers should prepare for volatile conditions and consider flexible financing.
Welcome to a detailed analysis from a Florida real estate expert showcased by Eurodollar University regarding current market conditions.
The expert outlines how rising interest rates and property prices impact buyers' decisions.
The expert highlights rising property prices as a significant concern. What implications might this have for prospective buyers?
The expert suggests that these increasing prices in Florida could pose risks for buyers both in the region and nationally. The expert indicates that the combination of limited supply and strong demand is pushing prices up.
Could this situation result in buyers being priced out of the Florida market?
If trends persist, significant portions of buyers might find homeownership out of reach.
What forecasts does the expert present for Florida's housing market in the upcoming months?
He cautions that if price increases continue, a housing bubble could form, suggesting a market correction could be imminent.
In summary, the Florida real estate expert advises investors to keep a close watch on changing market trends.
Potential buyers are encouraged to exercise caution in response to ongoing price shifts.
Today, we're exploring the economic analysis presented by Elon Musk, discussed in a recent episode from Real Estate Mindset.
Musk's insights delve into the challenges posed by inflation and potential impacts of interest rates on the broader economy.
Elon Musk predicts significant economic turbulence in the near future.
He emphasizes that rising inflation could lead investors to rethink their strategies. Musk warns that if inflation continues to rise, interest rates will likely need to be adjusted.
This situation raises questions about the Federal Reserve's ability to manage economic stability. Musk critiques Jerome Powell's approach, suggesting that it might not effectively address the current economic challenges.
He believes that there's a pressing need to reevaluate the monetary policies being implemented.
What does Elon Musk foresee for the economy in the coming months?
Musk indicates that investors should prepare for potential volatility in the markets as these economic factors unfold.
Musk concludes that staying informed and adaptable will be key for investors navigating these economic challenges.
Understanding the implications of monetary policies like those proposed Powell will be crucial for financial planning.
Welcome to the David Lin channel. Today, we delve into the stark predictions of Xueqin Jiang regarding the looming threat of global conflict.
Jiang's analysis raises concerns over escalating geopolitical tensions and military buildups that could lead to serious consequences.
Xueqin Jiang warns that the increasing militarization along key borders signals rising tensions that must be addressed.
She points to specific regions that are potential flashpoints for conflict, emphasizing their dangers. Jiang discusses how political unrest in various regions escalates fears of major confrontation.
It seems like each day, there's another headline about growing tensions.
Jiang highlights the increased defense budgets, indicating a shift in military readiness for possible conflict.
And with rising military exercises, it looks like leaders are preparing for potential confrontations.
What could be the economic fallout from a conflict like this?
Jiang warns of recession risks, stating that wars disrupt trade with serious repercussions.
What does Xueqin Jiang foresee if these tensions persist?
Jiang predicts that the potential for global instability will escalate significantly.
Jiang underscores the importance of prioritizing diplomacy to reduce risks and build engagement.
Additionally, she calls for communities and businesses to prepare for possible interruptions due to escalating conflicts.
In today's review, we delve into the discussion led by Gromen and Darius on the implications of expansive monetary policies.
Both analysts highlight the critical risks posed by ongoing increases in money supply and the resulting market dynamics.
Gromen warns that the continued increase in the money supply could translate into higher inflation rates.
Darius reiterates that past monetary policies have created short-term stability, but may have volatile long-term consequences.
Gromen elaborates on how inflation is tied to the surge in money supply, creating unsustainable consumer cost pressures.
Dale highlights that consumers are already feeling the pinch as living costs continue to rise. Dale points out that previous monetary interventions often led to cycles of boom and bust.
Gromen agrees, suggesting that historical lessons must guide current policies to avoid repeating mistakes. Both analysts predict that continued policies could lead to sustained inflation and necessary market adjustments.
Gromen emphasizes that understanding these trends is essential for preparing for future economic shifts.
Gromen and Dale underline that investors should seek sectors resilient to inflation to protect their portfolios.
Consumers should adjust their budgets, preparing for the likelihood of continued price increases.
That was an incredible lineup of perspectives today.
Absolutely. We had insights from experts like Gromen and Darius, who highlighted the pressing issue of inflation tied to monetary policy.
It's fascinating that while they agree on the importance of monitoring inflation closely, Gromen is a bit wary about the risks.
Exactly, and Darius's historical context adds depth to our understanding. It's clear that both approaches give us different lenses to view potential market behavior.
I was particularly intrigued by Xueqin Jiang's take on geopolitical tensions. She really emphasizes how current military buildups could signal something serious on the horizon.
Yes, and when paired with David Lin's analysis, it raises critical questions about how we prepare for possible global instability.
Now, shifting gears to the economy, Elon Musk brought up high inflation and the necessity for monetary policy reevaluation. A bit alarming, don't you think?
Definitely. His concerns echo the urgency that Emily Brown voiced regarding the real estate sector, now under unprecedented strain.
And then there's George Gammon, giving us valuable warning signs to watch for in the housing market. Today, offered a full spectrum of insights.
If you found today's discussion enlightening, make sure you hit that like button. It really helps us reach more viewers.
And don't forget to subscribe so you won't miss out on our future content. There's always more to explore.
Next up, we're diving into trade dynamics and their potential impact on the markets. It's going to be an exciting discussion.
Thanks for tuning in, everyone. We appreciate your support, and we can't wait to see you again.